Furthermore, what are the benefits? What are the benefits of raising money from your community? So, few words about my own background. My name is Reimo Hammerberg, and I am co-founder of Ignium. And my own background is financial services and law. So, in the last almost 20 years, I used to be as a capital markets and financial services attorney, practicing in the Baltic states and in the neighboring countries. So during my work, when advising, among other small and medium-sized companies in their corporate finance matters, then it brought me to the realization that the capital markets really for SMEs especially, but in general, they are broken. What does it mean they are broken? It means that capital markets do not connect. They are not available really for small and medium-sized companies. So that means that when the small and medium-sized business wants to raise money for their growth, it's not too many options what they have. They really cannot go to the bank because the bank will say your capital structure is too weak. You need to get some equity. So when now the small and medium-sized company wants to go to for equity funding, it's not too many options what they have. Private equity usually wants to do transactions which are, 3 to 5 million and larger. Very often those sums are too large for small and medium-sized companies. So there is a VC, venture capital, usually a usual small and medium-sized companies providing the usual services what we need on a daily life, food, beverages, clothing, etc. They are not interesting for VCs. They are after fast-growing tech companies. So then what is left? There is a good thing of crowdfunding, and they are the option from time to time. But crowdfunding is a quite expensive option as well. So the question really is, what we are going to discuss today is, how could you raise money more effectively? And furthermore, all this realization, when I saw this in the market, brought me to the idea that what if there was a capital markets infrastructure that could serve the small and medium-sized businesses, which could help them to raise money affordably and efficiently. So that's also on the back of which Ignium was born. So today, therefore also the webinar itself is addressed mostly to the small and medium-sized businesses. We will not be discussing that much about Ignium, well, quite a little. But it will be mostly about what would one consider as when they want to raise money from their community, from the small and medium-sized companies, CEO, founder, CFO perspective. So whenever you have questions throughout this webinar, please put them in the comments and we will take them as we move forward. And definitely there will be a Q&A in the end. So the setup for today will be presentation, 20 to 25 minutes in the beginning, and then the Q&A. So without any further ado, then let's get going. So I will share my screen and we can start. So we are Ignium and we are giving capital markets back to the companies. That's what I said also earlier. So the first question really is, why should one raise money from the community in the first place? What would be the reasons? So for first, of course, your community most likely has the money. So your community, I mean your clients and followers, they are most likely, a good portion of them at least, investors in some other sectors, whether they are in public equity, whether they are in crypto, whether they are in Forex, whether they are in crowdfunding. You can see also this, the numbers are pretty massive. It's a good chance that some of your customers, or even quite many, could be among those retail investors already active in the investment space. So on the other side, it's your company, right, in the need of funds. So you don't have the investors, but you have your clients. So, but those clients very easily could be your investors as well. So why would it be good to have your clients as your investors? So first of all, of course, because as we said, they have the money, right? So that is for one. Secondly, to raise money from your own customers and users is easier. So why is that? Usually, when you go and ask somebody to become your investors, so the first question what they will ask is, but what is the company? What do they do? Are they a decent company? Who are the managers? Who are the owners? Very importantly, what's their product? Is the product good? Does anybody want to have this product in the first place? Will the company be successful? Many of those questions, you could also label them as risk factors, actually would be addressed in case of your clients, because they know what your product is. Furthermore, they are actually the loyal fans of your products very often, right? They also know what your company is. The company has been there for a few years maybe already and serving thousands or tens of thousands of clients. So this is for first why it's good to have your community as your investors. First of all, they have the money, they have very often investment experience, and secondly, they know who you are. So the thresholds for accessing them as a source of capital will be simply lower. A second very important part is if you turn your customers, your investors, they most likely will become more loyal customers. So what does that mean? That means a reduced churn rate, or known also as the rate by which the company is losing its clients. So every time company loses a client, they have to win a new client. And acquisition of new clients, as we all know, is more expensive than keeping the existing one. So if you have more customers who are also investors, it's likely for them to become a brand ambassadors. So to spread more of word of mouth and bring in new clients. Hence, it could also positively have impact on the client acquisition cost. So acquiring new clients will become less expensive. And of course, loyal clients likely make more repeat purchases. And we all know that usually this ends up in a more profitable client relationship. So there are two very important groups of reasons why raising money from your community is actually a good thing. So first of all, capital is more accessible and the investors are already there. And secondly, by combining the relationship of the customer and investor, hence making your customers your investors, make them more loyal customers with all the benefits which are coming from that. So those are the reasons why it's good, or one should consider raising money from your community, tying your community even more loyal and more into a fan club. So today, after discussing the why, I really would like to discuss with you four main things. So, for first, who is eligible? Who is eligible to raise money from your community? Well, as often with those questions, there is no kind of clear-cut yes or no answer, right? So, but for first, in order to raise money from your community, it's good to have a community to raise the money from. If you have no community, then probably some other venues should be solicited for fundraising, such as crowdfunding platforms who have the groups of investors available from whom the money could be raised. But more specifically, say you have the community and this first, big box is ticked, then what else is helpful? Well, those factors are helpful here in the screen. First of all, the community is raising money from the community is easier for the companies who are retail facing. What does it mean? The companies who are selling their products and services directly to the end users who are retail customers. Why retail facing is better than business to business, for example, when the company is selling its services mostly to the other businesses? It is so because, when a business needs to make investment decision, whether to invest into its collaboration partner or supplier or vendor or whatever, usually corporate decisions take time. They are bigger decisions, and the company really must consider carefully that why they are investing into this particular collaboration partner, or shall the company start to invest into all suppliers? So this is the reason those are big decisions and not so easy to make, and often they are not in line with a company strategy. So rather, you would say business to business relationships. It's exception when when your customers are investing into you, as opposed to when you're retail facing, when your community of users or customers who are using your product are actually out there in a direct relationship with you. So the company who is retail facing is, well suited to raise money from its community. Secondly, it helps. It relates to the point of, first of all, you should have a community. If the company has been in business for a few years, what does that mean? That the company has existing clients. It's good if the company has thousands of clients. Well, if the numbers are greater in tens of thousands, it's even better. Because from those customers, they are already the loyal fans of your products, and they know what your company is worth, what the company is able to produce. And this is the source. This community, the pool of customers, is the source for capital. And as we saw, it's likely that they are already investing in other asset classes as well. So the second, the company should be in the business and having a community, hence some clients. Third, what is very helpful, not only have you your customers, but you also manage your community of customers through social media or other ways. In other ways, you keep your community activated. So why is that important? Because imagine you have been in the business for a few years, and indeed you are selling your products and services. And especially if you're not selling it directly, the customers may not be ready to interact with you. Furthermore, you may not have the direct communication channel with your customers or with your community, because in order to raise the money from your community, you must be able to interact with your community. And it helps if this interaction or communication channel is already there and activated. So those, first of all, the company to have the community, then the company retail facing, have been in business for a few years, has customers, and the community is activated. So on top of that, what helps is the company sells its products and services directly to its customers as opposed to through intermediaries. For example, if we have a small or micro business selling it, say the company produces handicraft cheese, right? When the cheese is sold directly to the end customers and the customers are interacting with the company through the social media, it's easy for the company to reach out, and the company has a direct relationship, as opposed to the company which, for example, produces also handicraft cheese, but sells it to the restaurant and cafeterias, right? So the end customers of those restaurants may never realize whose cheese are they actually eating, and they so much appreciate. So this is why also it's helpful when the company sells its products and services directly to the end customers. It's not really vital to have it, but it's helpful. And furthermore, when the company sells to customers across borders and through its own website. Again, there is additional, what does that mean? That means that the customers are interacting with the company even more. So again, as a result of the sales channel, the activation is already there. So every time customers are buying something, they're interacting with the company. So that's why, when the customers are there across the borders and buying directly through the website. It is kind of the sign of a further activation and helps also, therefore, to raise money from the community. So those are the main points. But as I said, it's not kind of the blueprint that no other company is eligible. But when the company has those elements present, then the company is well suited to raise money from its community. Well, the question could be asked, if some of those elements is missing, is the company uneligible? Certainly not. We have just concluded or completed one joint fundraising with one of our customers, and they didn't have some of those points there, but still were successful and raised almost $250,000. But let's move forward. The second thing that I wanted to discuss with you today is the question of valuation and instruments. So the first big question is, when I'm going to raise money, then of course, first of all, what instruments am I going to use? Or plainly speaking, what am I going to give to my investors or Investomers? What will I give to my community in return for the money that they will give me? So that indeed brings us to the question of valuation and what instrument to use. The valuation, it's a kind of it's a mystified topic. I've been in corporate finance for almost 20 years, and I've seen it from different perspectives. I've seen the valuations, how they are compiled for the purposes of acquisitions. I've seen the valuations for the purposes of capital raising, and I've also seen the valuations in the litigation and how the valuation reports are ripped apart in the course of a dispute when discussing how much something is worth. So what are the main valuation methods one should consider? First, there is kind of, three main approaches which are there available. First is cost approach. Effectively, how much are the assets worth what the company has? So in other words, if the company you would think of the company value in terms of how much would it cost to replace the assets of the company, cost approach. Or alternatively, you could think, if I would sell all the company's assets today, what would I get? This is called cost approach. Kind of, it denies the very fundamental notion of the company, that the company is viewed as a going concern, producing value as a result of the cash flows, what it produces. So the cost approach is there, but it's kind of really denies the aspect of the company as a going concern. So the next big kind of a group of valuation methods is market approach. Effectively, usually it's used for the public companies traded on the stock market. You look at the similar companies, you look at the benchmarks and say, well, if a similar company is valued that much, then my company should be valued similarly. Or if my company is a little different, then you try to tweak this valuation respectively. But effectively, it's using the benchmarks available on the market. And usually kind of stock markets are used for that purpose. And the third big group is income approach. So that's where we effectively, the main methods are, for example, EBITDA multiplier. So effectively, you take the profit of the company, free cash flow of the company, expressed also as earnings before the taxes and earnings before the interest and taxes and depreciation and appreciation, EBITDA. But effectively, you could say it's a company profit, free cash flow. And you apply a certain multiple to this. So the usual multiples applied for the small and medium-sized businesses are, 4, 5, sometimes 6. So you take the company profit, multiply by 4, to get the company valuation. Pretty simple, right? So the next, which is here often used, is a discounted cash flow. So this is a pretty complex method. You take all the estimated future cash flows of the company and then apply the cost of capital. This method is full of assumptions, because when the first or the previous method, the profit multiple looks to the past, say, okay, in the past I had, profit of, I don't know, 1 million, then, or what, 1 million, and then you apply it the multiple of 4, say, then the company value is 4 million. It presumes that the company will perform the same way in the future as it did in the past. Discounted cash flow method, however, it looks to the future and says, what do I think the future cash flow will be, and what is the expected return by the shareholders? And then, as a result of those, I discount all those future cash flows into today, and I get the what is called present value. This method is full of assumptions, often used for the big corporations to derive at the right valuation. The benefit of that approach is that it's more forward-looking as opposed to the backwards-looking. And there are, variations of those methods. For example, like the multiple of the annually recurring revenue and others. So those are the methods. Kind of like you would be taught. This is like a crash course into a corporate finance class that you would usually get. But let's move forward and let's try to get more practical here. Let's take actually two actual crowd-funded companies and kind of preserve the anonymity of those companies. So we call it first company and we call it the second company. So the first company is a newly established startup, has just a product prototype, does not have the distribution network yet established, has no revenue, no profit, and no production, no scalable production yet, but has developed a good product prototype for which it has got a good feedback from the market. And we have a second company. It's been 6 years in the business, revenue approximately, estimated revenue for this year, 2021 is 2.5 million, and profit approximately 500,000. Last year, the profit was about 300,000, and revenue also, I believe, less than 2 million. So the estimated results for this year are better. So now the question is, but those are the actually crowd-funded companies, both campaigns more or less closed, and we know the valuations of both of those companies. So now trying to apply, just a quick recap, trying to apply those methods to those two companies. So the cost approach for the first one, right, doesn't have any assets, so the valuation should be zero. Market approach. So none of them are really on the market. It's kind of for neither of those companies, publicly, traded company information is not simply relevant. It is simply, it is different type of company, different kind of corporate world out there. So what we are left with are income approach for the first company. But the income, as we remember, right, was zero. The profit was zero. So should the valuation be then for company one, zero? Let's apply now the method. I will give the answer very soon. But now let's apply a second company, facts, also to those methods, or rather the methods to the second company, facts. The cost approach. The second company definitely has some assets. So some, food production equipment, some facilities, didn't really check, but those could be worth of, a million, around $1 million or so, but maybe less, maybe 500,000. Again, market approach, also not relevant. Income approach, well, if we apply the multiple of 4, we should get a 2 million for the valuation, provided they will make the 500,000 profit this year. So this is where we are with those two companies by the valuation methods, right? The conventional valuation methods would tell the first company valuation is zero, but yet they raised money. And the second company valuation should be, 2 million at best, 2.5 absolutely max, right? Asset base probably does not give that result, but multiplier would give that. And TCF is so complex, no point to go there, and it's full of assumptions anyhow. So what is the true valuation of those two companies. So the first company actually raised successfully more than 100,000 at the valuation of 500,000. So the valuation was not zero, right? It was 500,000, and it raised money, more than 100,000. The second company valuation is about 10 million, and they successfully are raising also more than 200,000 euros. So what do we conclude from this small play of facts, right? Valuation of our companies is art as much as a science, right? It's 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 not that you have to apply those methods. It's simply, what it feels is correct. And often, question of valuation comes along with how much money would I like to raise? How much money do I need? Because often during one funding round, the company is not expected to give away than more than, 10, 15%. This is what is the expected dilution. In other words, how the company existing shareholders, how much company existing shareholders shares are getting smaller. So this is what it is. So I'm simply my conclusion on the point of valuation for all small and medium-sized company and micro company managers. Don't be intimidated by the issue of valuation. Valuation is effectively a function of how much money you need and how much shares are you going away. Usually, you shouldn't be giving away in one round more than 10, 15, maximum 20%. So if, for example, you want to raise 50,000, the expected valuation is 500,000. Even if you're an early stage startup, like our first company here. So this is how I would conclude the topic of valuation. So I would next now you move to the topic of which instruments should I use. In other words, investors are giving me money, my community is giving me money. What will I give them in return? So, and it's kind of really two main choices here. There is a debt financing, usually in the form of convertible debt, which is a long-term instrument, and secondly, there is a typo here on the screen. It should be equity financing. So the equity or debt, convertible debt is actually not suitable, in my opinion, in most of the cases. Even though it's used quite a lot, it is a complex instrument, often used by the professionals, but even professional investors are preferring equity. So when you are now raising money from your community, who most likely are retail investors above all, then equity, in my opinion, is the best instrument. And equity comes in the forms of shares. You would know company shares, company stock, right? And effectively, in return, then together with the question of valuation, you would give to your investors or customers community a certain percentage of your share capital. In our example, you have an early stage startup, you raise 100,000, you give them, 10 to 20%. Next, I would like to move, and third, to the legal considerations. Legal considerations, I wouldn't, given my background, probably I have to watch myself not to stay too long on this topic, but I consciously want to be very short. The legal considerations when raising small amounts, and I mean the amounts of, less than 1 million, less than 2 million, are actually twofold. Legal considerations related to issuing securities, that mean corporate resolutions which need to be made to authorize the issuance of new shares, and selling and marketing. So when selling and marketing, effectively, when raising small amounts like less than 1 million, certainly less than 500,000, it's unregulated activity other than simply the company must tell the truth. You don't have to make a prospectus, you don't have to register the prospectus, there is no hassle around that. But simply whatever disclosure is made, The disclosure must be truthful. No undue promises, no misleading statements, etc., etc. In general, as far as the legal considerations are concerned, again, it's often mystified topic. It's not that complex, but still, here I advise you to still involve a legal counsel into the process, even for those simple things as, documenting the corporate resolution for authorizing issuance of new shares. For fourth, I wanted to speak about the marketing and communication. Well, the first thing, about marketing communication, if you have the community and the community is activated, then of course it's easy, right? You simply, turn to your community and ask, should I get money or would you give me money? And they are giving you the money. And we have seen among our own customers that this is how it works. Actually, customers are very responsive. They are giving the funding and they are very, forthcoming and happy to support the support the company whose customers they are. However, things may not always be there, even if you have the community and even if the community is activated, some things are there which are good to follow in terms of marketing and communication of your capital raise. So you have your community is activated. The first step, what is good to do is simply, do what is called in capital markets, market sounding. So effectively, what do? You simply reach out to your community with a simple question that we are considering, fundraising for, doing this, that, and third for those investments. And would you be able to invest? No strings attached, no commitments, but effectively, simply, if you are interested, please submit your interest here. And that's it. This is often done with the capital market transactions as well. And the reason why it's done to mitigate the risk that a lot of effort is being made and then the transaction fails. Undue spending of time, money, and simply also the kind of the unpleasantness of the failure of the transaction. So one thing what can be done, and what I would recommend as well, is a market sounding. Reach out to your customers and ask, would you be interested? No strings attached. Second thing is have a pre-prepared communication plan for your fundraising. So in other words, when I will publish, what will I publish, and then be monitoring the progress and the impact of those communications, how the fundraising is going, how responsive is the community. If the communication is not working, as usual, the communication should be tweaked. But in general, it is campaign or doing the campaign or marketing campaign for your fundraising is not difficult from any campaign you would usually do to sell your goods and services. It's also communication. It is also marketing in the end. Should be kept in mind is that here the communication also, the bottom lines that communication should be transparent, communication should be truthful. But as I said, it can be that community is already activated, not much is needed, and everything goes simply smoothly and the transaction closes very seamlessly. I have seen on our own customers both options. Transaction going to the closing in just in few days, and also the other customer, where the community didn't step up in such extent, did it to some extent, but the rest of the money the company simply raised as a result of marketing and communication and did so successfully. Or what I'm simply saying, it's a marketing and communication is also something that needs to be planned. Doesn't have to be too much budget for that at all. Some social media ads and some content marketing can be very helpful, but usual marketing thinking around it. And if all those four things are done, properly, right? It's you have thought properly about the valuation and kind of put the fair valuation in place. As I said, it's more of an art than science. And usually, especially when you think of the SME valuation, it's not, I suggest not to focus rather on those, different complex methods. They are not simply relevant, but think in terms of fundraise, the money you want to raise, and in terms of valuation. And usually, you should not dilute more than 10 to 20% max. Secondly, what instruments to use? Equity is preferred. Then third, the legal consideration. Above all, whatever communication there is, it should be truthful, and the corporate authorization. And that's it. When you do all this, community is there. You are you have the community, you are the retail facing company, then it all should be very easy and seamless process. So the customers simply, they come, knock on the door, and they are investors. Simply through the intermediation of your own social media and website. That's it. Should be easy and quick process. And that is it. That's what I wanted to share with you. I encourage you all who have fundraising plans and have the community reach out to us if you are interested. We have just concluded, one of our clients concluded just a crowdfunding campaign on their own, raising money from their own community. Just to make clear, Ignium is not a crowdfunding company. We are not raising money for the company. The company is raising money from their community itself. We are just facilitating that by giving the company the tools and the infrastructure. But with that, I would actually conclude and open it up for the questions. So what do we have here? So let me start taking the some of the questions. Is there a introducing affiliate program? Indeed, we do. Anyone who brings Ignium a small and medium-sized company who will issue assets with us will get the 10% from the trading commissions from that issuer securities. So there is one. So what is the next one here? What is the minimum available raise amounts for SMEs at the market now? That is a very good question, actually. So as we are not a crowdfunding company here, and companies raising money through their own website, there is no setting up of the campaign, no long preparation of the campaign, etc. The community, if the community is already activated, no amount is too small. Yes, we just saw almost quarter of the million being closed by one of the customers raising money on their own. But if you take it from that perspective, no amount is too small, right? Can be 50,000, can be 40,000, can be 100,000, just as the company may need it. Because again, there is no arranging fee that Ignium will apply on the transaction size. Hence, we are also not arranging the transaction. The company is doing it itself. So there are not the usual investment banking barriers that the deal is too small, right? Any deal is good for the company. What are the minimum available raise amounts for the, sorry, could you, how to define the amount of need of funds to be raised? Well, this is This is a fair question. Usually, it all starts from the question: what what do you need to do with the money? What do you need the money for? Right. Usually, the company has a very clear investment plan, what they have in mind, right? Whether it's a new factory, whether it's a new equipment, whether it's expanding to the new market, et cetera, et cetera. Whether it's new recruits, so different things, launching of a new product. So it all defines how much money should be or needs to be raised. The company should, of course, explain that to its community, what the money will be used for. So then we have Are Tammemäe question there, who is commenting that it's called valuation. So Ilya, if you can put it on Are's comment there, it's called asset valuation approach. I say Are, it's kind of, it has good children have many names. It's called differently in different methodologies, but fair enough. It's also called asset valuation sometimes approach. Appreciate the comment. So what else? What other questions we have there? When is the next increased Ignium valuation? That is really, well, the increased valuation will be really for the market to decide. We're working hard to build a company, to build a product. And we are going into the next funding raise probably, first quarter next year. So hopefully the company will be worth more than it was before. But it will be defined by the market forces. That's what it is. It's really difficult to say. But we are in the place of next funding round, probably somewhere first half of next year, probably in first quarter. So how does the company you represent is related to the raised webinar topic? Very good question. So the company I co-founded and that I manage, I'm a CEO of Ignium as well, is related to the webinar topic by enabling this to happen. So to raise the money from the community is, it requires certain infrastructure there to be in place, because yes, you will turn to your customers, but the questions what will need to be tackled: who will issue the shares? Who will keep the cap table? How do you accept the money? How do you issue new shares? How do you interact with your investors once they are onboarded? How do you take care of the compliance, KYC? So that's where Ignium comes into play. So I will now share the screen for 1 sec. Right, share screen, and I will go back to this slide. So this is what we do with Ignium. So there is a company and company's website or social media, and it has the customers interacting either through the website or social media. So with Ignium, we enable effectively to plug our infrastructure, security token infrastructure, into company's website, so that the company's investors or customers, to be investors, can become investors with a click on the button. And it's a seamless process without intermediaries. And furthermore, once this has happened, that the company has raised the money, it is not over. Yes, the company got the money, but then still the journey of the investors continues, and the company would like to get even more of those customer investors, Investomers. So what we enable the company to do is to keep the invitation, the digital door, what you say here also, connecting kind of the company side with Ignium, we keep it open, but then already for the secondary market purposes, where the new customers of the company can come and buy more securities from the existing ones, hence creating some liquidity and secondary market. Here, on the basis of that company. And that is their one seamless solution, which the company effectively can plug and play. They plug the infrastructure into the website and raise the money through their own website and social media. This is how Ignium is connected with the topic in question, because this is our mission to give the capital markets back to the companies. And this is how we do it, right? To enable small and micro and medium companies to raise money and do that cost effectively, affordably, and in a manner which is resilient. So let's move forward. So here, this part of the question, what I will say, it's I explained what Ignium does, and what do I mean by that? We are not a crowdfunding company, meaning we are not doing a investment banking service. What do I mean by investment banking? Is that crowdfunding companies, they are nothing that much different than investment banks, but they are retail-facing investment banks acting through the platforms, focusing on retail clients. So what they do is they prepare the company, prepare the presentation, they introduce the company and the presentation to the investors who they have in their network, so to speak, the same what investment bankers are doing. Then they run the campaign, they support the company, and finally they help the company to close the deal. And then as a result of that, in return for arranging this transaction, for doing the placement, they take their fee, which is usually percentage of the money raised. And usually it's between 5 and 7% plus retainer fees. As we are not doing this placement service, we are enabling and empowering the company to do that and raise money from their community. Then we are not also taking the arranging fee. So we are not doing this placement or investment banking service. I hope that answers the question. So, sure, we can do that, and this has been in the making also, that we could do that from our website, but it's not there yet. But it's please reach out after this webinar, and we can discuss how we could do that. I don't know at the moment. It's not that far. Currently, we are still building a private company here, and the funding. But at some point, let's see what will happen to the stock markets in general, what the future will hold, because the general trend in the world is that more and more companies are staying private, and for the same reasons, what we are just what we are doing with Ignium, kind of owning private company shares is easier and less frictionless than owning public company shares in these days already. And the benefit of tradability, there is more and more liquidity coming to the private markets as well. So let's see what the future will hold, because we are actually in the middle of seeing major disruption in the private company market. So and the liquidity and everything what is associated with it. So let's take the last question. Indeed, yes, we are getting to the end. So what do we see here? That is a very good question. So the reason is very simple. We are early stage startup ourselves. So I quitted my law practice only a year ago. We've been actively building the company a little more than a year. Before it was indeed writing of the code beforehand, but it's indeed this is kind of been simply a function of the time, and effectively no marketing and sales so far. So and we're still in the process of tweaking our product, because the way we are currently introducing this, that companies can effectively plug Ignium infrastructure into the website, raise the money from their own community, and then run secondary market on the same way, it is not really done anywhere. It is a new product, and we have to really test how it works exactly and whether our key hypothesis will hold. So that's why also at this stage, what we are looking for are the companies who are early adopters and who would like to raise money from their community, but would be therefore also ready to, experiment a little more than late adopters. But that's the reason why we have quite few companies there. So with that, I would conclude the webinar. Thank you for the questions, and until the next time, have a good time and be well. Take care.